What home builder executives are saying behind closed doors should terrify every homeowner, potential buyer, and real estate investor in the country. The American housing market is standing on the precipice of disaster, and industry insiders are finally sounding the alarm. Welcome to today's deep dive analysis. We're going to walk you through exactly why the nation's largest home builders are implementing dramatic price cuts of up to 18% across their new home inventory, and why this correction could potentially be more devastating than what we experienced in 2008. Let's start with the cold, hard facts. According to the most recent data from the National Association of Realtors, housing inventory has surged by 23.7% year over year, while actual closed sales have dropped by 17.4%. This fundamental imbalance between supply and demand is creating dangerous market conditions. The S&P Case-Shiller U.S. National Home Price Index shows home prices have increased over 57% since 2019. This means homes have appreciated at 3 times the historical average rate in just a few years, creating an unsustainable bubble. Mortgage rates have more than doubled since 2021, with the average 30-year fixed-rate mortgage now hovering around 6.7%, pricing millions of potential buyers out of the market entirely. The Mortgage Bankers Association reports mortgage applications are down 28% from this time last year. The affordability crisis has reached a breaking point. The average American household now needs to spend 41.4% of their income to afford the median-priced home, far above the recommended 30% threshold for housing costs. So, what's driving America's largest home builders to slash prices and offer unprecedented incentives? Let's look at the hard evidence from the industry's biggest players. PulteGroup, America's third largest home builder, has implemented the most aggressive strategy, cutting prices by a staggering 12 to 18% across multiple markets, with the deepest reductions in western states like Arizona, Nevada, and Colorado. They're also offering mortgage rate buydowns of up to 1.5 percentage points and up to $15,000 in closing cost assistance. Their recent quarterly results revealed the desperation. New orders down 21%, a cancellation rate of 19.4%, and average sales prices already falling 4.8%, despite these being early days in the correction. DR Horton, the nation's largest home builder by volume, has slashed prices between 9 to 17%, with their most recent significant reductions in once hot markets like Texas, Florida, and Arizona. They're offering up to $20,000 in closing costs and options incentives, plus aggressive 2-to-1 mortgage rate buydowns to attract increasingly hesitant buyers. Their focus on entry-level and first-time home buyers makes them particularly vulnerable to interest rate shocks. Their recent quarterly results show new orders down 18%, an alarming cancellation rate of 21.6%, and average sale prices already declining 3.2%. KB Home has implemented price cuts of 10 to 15% across their western and southern markets, with particularly deep reductions in California and Texas communities. They're offering substantial incentives including free upgrades, solar panel incentives, and closing cost assistance up to $22,000. Their quarterly results are perhaps the most concerning among major builders. New orders down a devastating 24%, cancellation rates at 23.5%, nearly 1 in 4 buyers backing out, and average sale prices falling 5.1%, the largest decline among major builders. Lennar, the second largest U.S. home builder, has cut prices by 8 to 12% nationwide, with deeper reductions in rapidly cooling markets like Boise and Salt Lake City. They're offering mortgage rate buydowns to the 4% range and design center credits up to $30,000 through their Everything's Included packages. Their quarterly results show new orders down 12%, cancellations at 16.8%, and average sale prices declining 2.9%. Even Toll Brothers, which focuses on the luxury segment that is typically more insulated from market downturns, has reduced prices by 5 to 7% in their Northeast and West Coast communities. They're offering limited-time rate locks at 5.99% and massive design studio credits up to $75,000 to move inventory. Their quarterly results, while less severe than other builders, still show warning signs. New orders down 9%, cancellations at 11.2%, and average sale prices starting to decline at 1.2%. Major home builders dramatically increased production in response to the pandemic housing shortage. New housing starts increased by 22% in 2021 and another 14% in 2022. This massive wave of new inventory is now hitting a market where buyer demand has cooled significantly. Census Bureau data shows there are currently 1.7 million housing units under construction, the highest level since the 70s. Meanwhile, cancellation rates for new home contracts have reached 21%, nearly double the historical average. The home builder industry faces a brutal reality. They've built too many homes for a market that can no longer afford them. The aggressive price cuts and incentives from PulteGroup, DR Horton, KB Home, Lennar, and even luxury builder Toll Brothers represent desperate attempts to move inventory that's sitting unsold. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel, keeps us motivated to keep making you great content. Thank you. Now, let's continue. The Federal Reserve's aggressive campaign against inflation has fundamentally transformed the housing market landscape. When mortgage rates leap from 3% to nearly 7%, the math becomes devastating for buyers. Consider this example. On a $400,000 home with 20% down and 3% interest, the monthly payment equals $1,349. At 6.7% interest, that same monthly payment jumps to $2,066. That's a 53% increase in monthly costs. The same house became unaffordable to millions of Americans virtually overnight. The Mortgage Bankers Association estimates that for every 1% increase in mortgage rates, approximately 2 million potential home buyers are eliminated from the market. For volume builders like DR Horton, which constructed over 81,000 homes in 2023, and PulteGroup, which built over 29,000, this sudden evaporation of qualified buyers has forced their hands on pricing. While unemployment remains historically low, we're seeing concerning trends in the labor market. Major tech companies have announced over 175,000 layoffs in the past year. The manufacturing sector has shed 48,000 jobs in the last quarter. Initial jobless claims have been trending upward for 6 consecutive months. More worrying is wage growth, which has fallen from 5.9% to 4.2% year over year, while inflation has remained stubbornly above the Fed's 2% target. This means real wages, adjusted for inflation, have been falling for 24 consecutive months. When Americans' purchasing power declines while housing costs skyrocket, something has to give. The unprecedented scale of price reductions and incentives from all 5 major builders signals they can recognize this fundamental economic reality. Institutional investors were responsible for buying nearly 28% of all single-family homes in 2022, an all-time high. These corporate buyers drove prices higher by paying above asking price and purchasing with cash. Recent data from CoreLogic shows these same investors are now net sellers for the first time since 2016. In fact, institutional investors have reduced their housing portfolios by 14% in the past 6 months. When the smart money starts selling, everyday investors should pay very close attention. The significant price cuts from PulteGroup, DR Horton, KB Home, Lennar, and Toll Brothers suggest they're seeing the same warning signs that are prompting institutional investors to exit the market. The 2008 crisis was fundamentally about subprime lending and financial leverage. This time, the crisis is brewing from a different source: fundamental affordability. In 2008, the average home price to median income ratio peaked at 4.7, meaning homes cost about 4.7 times the median household income. Today, the ratio stands at 6.3. Homes are substantially more expensive relative to incomes than during the peak of the last housing bubble. Household debt is also concerning. Total household debt has reached $17.29 trillion, with mortgage debt accounting for $12.1 trillion. The average American household now carries $103,358 in total debt, up 35% from pre-pandemic levels. While lending standards are stronger today than in 2008, the sheer weight of this debt, combined with rising interest rates, creates a precarious situation. When America's top 5 home builders simultaneously slash prices by up to 18% and offer tens of thousands in incentives, they're acknowledging a simple mathematical reality. Home prices must fall to meet affordability constraints. Let's break down what these reductions would mean across the broader market. PulteGroup's 18% price cuts, if applied to the median home, would drop prices from $431,000 to approximately $353,000. Monthly payments on that median home would fall by about $450. Even Toll Brothers' more modest 7% reductions in the luxury segment signal trouble at all price points. These corrections are not just possible, according to industry actions, they're already happening, especially in the most overheated markets. When major builders like PulteGroup and DR Horton make such aggressive cuts, they're signaling to the entire market that the era of ever-increasing home prices is over. Not all housing markets will be impacted equally. Data from Moody's Analytics identifies these metro areas as most vulnerable to significant price declines. Austin, Texas, with current overvaluation at 61%, Boise, Idaho at 58%, Phoenix, Arizona at 54%, Nashville, Tennessee 49%, and Tampa, Florida 48%. These markets saw the most dramatic pandemic price increases and have the most significant imbalances between local incomes and housing costs. It's no coincidence that PulteGroup's deepest price cuts are occurring in Western markets like Phoenix, where they've reduced new home prices by as much as 18% from their peaks. DR Horton is cutting aggressively in Texas and Florida. KB Home is slashing prices in California and Texas. The pattern of price cuts matches precisely with the markets Moody's identified as most overvalued. If you're currently shopping for a home, this analysis suggests considerable caution is warranted. Purchasing now before a potential 20% correction could mean immediately losing tens of thousands in equity. Consider these strategic approaches. Extend your rental lease if possible. Renting for another 12 to 24 months could save you significant money if prices decline as predicted. If you must buy, negotiate aggressively. Sellers are losing leverage by the day. Data shows homes are now selling for an average of 3.8% below asking price, compared to 5.1% above asking price just 12 months ago. Consider new construction from builders implementing price cuts. PulteGroup, DR Horton, KB Home, Lennar, and Toll Brothers are all offering unprecedented incentives, including mortgage rate buydowns, massive closing cost assistance, and direct price reductions to move inventory. Focus on affordability metrics, not emotions. Don't exceed 28% of your gross income on housing costs, regardless of what lenders approve. If you already own your home, don't panic. Consider these steps. Refinance if possible. If you have an interest rate above 7%, explore refinancing options as rates have moderated slightly. Accelerate mortgage payments. Building equity faster provides protection against potential negative equity scenarios. Delay home equity loans or cash-out refinances. Tapping equity now could be risky if prices decline significantly. Consider selling investment properties. If you own multiple properties, especially in vulnerable markets like those where PulteGroup, DR Horton, and KB Home are cutting prices most aggressively, now may be the best time to reduce exposure. Real estate investors should be extremely cautious in this environment. Cash flow is king. Only purchase properties that generate positive cash flow with conservative vacancy assumptions. Avoid speculation. The days of buying solely for appreciation are over for the foreseeable future. Target distressed opportunities. As the market corrects, distressed sales will increase, potentially creating buying opportunities. Consider alternative real estate investments. REITs, particularly those focused on recession-resistant sectors like medical facilities or data centers, may outperform direct property ownership. The combination of historic overvaluation, 57% price growth since 2019, interest rate shocks, rates more than doubling, declining affordability, 41.4% of income required for median home, supply surges, 1.7 million units under construction, institutional investors selling and slowing wage growth, and early job market warnings creates a perfect storm for housing prices to correct significantly. When all 5 major builders implement price cuts ranging from 5% to 18%, they're simply acknowledging the mathematical reality that the market can't sustain current price levels. History doesn't repeat, but it often rhymes. While the specifics differ from 2008, the current housing market displays many concerning parallels, primarily extreme overvaluation relative to fundamentals. The coming months will be critical. Watch for these key indicators. Housing inventory levels continue to rise, days on market increasing beyond 90 days. mortgage delinquency rates ticking upward, and builder cancellation rates exceeding 25%. These would confirm the correction is accelerating. Remember, housing markets don't crash overnight. They deteriorate gradually, then suddenly. The aggressive price cuts from PulteGroup, DR Horton, KB Home, Lennar, and Toll Brothers suggest we're entering the suddenly phase after months of gradual deterioration. For most Americans, their home represents their largest asset. Taking protective action now, before the market potentially declines by 20% or more, could preserve significant wealth and financial security. Leave your thoughts in the comments below. Do you believe we're heading for a housing collapse worse than 2008? How are you preparing? Thank you for watching this analysis, and please make sure you subscribe for more market insights if you found this information valuable. And watch this one as well.